Today, we're going to start off talking about tax composition, which is sort of what comprises revenues here in the US, and we'll talk about a bit about other countries as well. We're going to talk about the basis on which we evaluate tax systems. What is a good tax system and how do we judge a tax system? We'll talk about the US federal individual income tax. We'll talk about it in nitty-gritty detail, and we'll actually come back to it at the end of class when we do the Mitt Romney 1040. We'll go through exactly why Mr. Romney paid roughly 13.9% of his income in taxes. This is not a political judgment. You know, you can like Mr. Romney, you can dislike Mr. Romney. It's more of an analysis as to why this is. You know, it's been in the news a lot, especially I think his effective, i.e., average rate, has been in the news a lot. And I think there's a lot of things been said in the popular press about why this is, and various things about his income streams. And I think it'll be useful for you guys to actually have something to say about that stuff, given that you're taking a tax class right now, given that you're taking a public finance class. It's something you can actually say to your friends, you know, over drinks and at parties, right? You can, okay, maybe not you, maybe just me, but yes, you guys can be the hit of all entertainment venues. Okay, so we'll talk about the individual income tax. We'll actually get to talking about sort of the tax system at a larger level. We'll talk about US tax expenditures. And one of the things I really want you to sort of take away from this class is that a tax expenditure is not really different than spending. It has some different characteristics in some way, but it still has the basic notion of spending. We're just spending for the tax system. And then finally, we'll talk about the tax unit, so family versus individual income taxation. Depending on time, we may not quite get to 5, but Gruber does an excellent treatment of that in the last section of chapter 18. So if you don't get to it, you're in good hands, having read the Gruber chapter. Okay, so go ahead and, so from now on, just if you come in after I've sort of had people hand me stuff, whoa, there's another one. Go ahead and stay in your seat, and I'll pass you slides. We'll handle it that way, just so there's less back and forth. Okay, so let's go ahead and talk about tax composition. So at the federal level, the taxation of sort of wage and salary income makes up a bulk of our revenues, because it comes in 2 different forms. There's payroll taxation and individual income taxation. Individual income taxation includes other sort of income streams, such as interest and non-qualified dividends and business income. So it's not all labor income, but a lot of the individual income taxes are actually on labor income too, by which I mean wage income or salary income. So you can see at the federal level, a lot of what we're taking in is on sort of human labor supply, right? We have a slice of corporate taxes. That's the pink piece at 11.3%. We'll talk about corporate taxes more in a minute. But corporate taxes make up, somewhere between 10 and 15% of federal revenues, depending on where in the business cycle we are, right? Because firms are differently profitable in different parts of the business cycle, and that sort of changes their share of revenues. Excise taxes are a pretty small share at 2.6%. Most federal excise taxes are simply gasoline taxes, what we pay at the pump per gallon of gasoline. That's what most excise taxes are at the federal level. And then there's other stuff, which is another 4.5%. That's going to include things like fees and tariffs and et cetera, et cetera. If we look at state and local government, which is our middle pie, you can see it's a far more balanced pie than our federal pie. So in this case, we have, income taxes at 16%. States and localities actually garner a good amount of revenue from sales taxes. We see it on our receipts, right? It's a largely state tax, but some localities have sales taxes, like counties have sales taxes, and here in New York, I think there's a New York City sales tax. Federal grants make up 20% of state and local revenues. Those are transfers from the federal government, so from the federal government's revenues to the states. And those can come in a few different ways. They can come in the form of block grants, such as in the case of cash welfare. They can come as matching grants, such as in the case of Medicaid, which is health care for the poor, which we'll talk about later. In the second half of the course, we'll talk much more about Medicaid. It can also come as sort of just other types of grants like Title IV funding for poor children in schools, like federal lunch programs, et cetera, et cetera. So that's sort of 20% of the state and local pie. Property taxes, right, is a revenue source that we don't see at the federal level. Property taxes are sort of real estate property taxes. It's one of the few wealth taxes we have in the US, and that's about 21% of state and local revenues. Other, another 21%, that's a whole range of things, including severance taxes, for example, on the production of oil and gas in a state. And income taxes make up a smaller share at 16%. So states do have income taxes. Some don't. There are some exceptions, some don't. Most have income taxes of some kind. And in some cities, like ours here in New York, there are city income taxes as well. Most cities don't have them, actually. So if we look at the total of government in the US, we can see that income taxes are a big source of revenue at the net level, State, local, and federal combined, that's the big green pie piece at 35%. Payroll taxes are still a large share, roughly a quarter. Consumption taxes, which is sales taxes and other kinds of consumption taxes, are about 16%. Here's where we see the corporate tax at the total level of government is only 6.5% of total government revenues, state, local, and federal. So I am a corporate tax economist. I study it from a policy perspective. That's why I teach at a policy school. But this is sort of what you'll get a little bit more of with me than you would with someone else, like it or not. This is what you'll get a little bit more of with me than you with someone else. And so I think it's actually an interesting part of public finance. And while my sort of version of public finance is probably less internationally focused than other professors might handle it as, one of the things we will talk about is how the rise of the multinational corporation has made it harder for the federal government to raise corporate tax revenue. You can turn this stuff in later. So right here we have a graph of corporate revenues, so revenue from corporate income taxes as a share of gross domestic product. We can look at it in different terms and look at it as a share of federal revenues, right? And we see the same pattern, that there was a time where we collected a lot more revenue, right, from corporate income taxes, and this sort of declined over time, and while there is some wiggling around, it's sort of steadied at a lower rate, right? It's a much lower share of total revenues. And this is an interesting sort of issue the federal government faces, right? Because it's harder and harder to sort of raise real revenue from the corporate income tax. And there are many reasons for this. People argue different things. Some people suggest that it's the rise of the limited liability partnership, so that you can get the protection of incorporation when it comes to protecting your personal assets while still having income pass through, i.e. you don't retain any earnings in the corporation, you get taxed at the corporate level, you just pass the income through to the partners. The rise of that, some people argue, has reduced the sort of revenue we gain from corporate income taxes. Others, and this is sort of, I think, widely acknowledged, says that it's the rise of sort of the multinationalness of corporations, right? That as multinational corporations have come to sort of be a larger feature on the scene, the fact that they sort of operate in different tax jurisdictions makes tax arbitrage an opportunity for them to minimize tax liabilities, and makes it harder for a relatively high tax country like ours to raise the revenue we used to raise. Am I saying we're the highest tax country in the world? No. Are we a higher tax country on average for corporations? Yes. Yes. Because if we think about these tax pies, we go look at Europe, you'll see that, first of all, one of the features of European countries is that sales taxes at the federal level are a far larger source of revenue. They usually have what we call VATs, value-added taxes. We'll talk more about them during tax reform. So consumption taxes are a bigger feature in Europe at the federal level. We also see that individual income taxes are prominent in European countries as well. What we see often in Europe is that corporate income taxes are small. And it sort of has to do with various things. It could be cultural, it could be various factors, but it's also because Europe's member nations are far more integrated with the economies of their neighbors. So when you try to tax capital, tax incorporation, it's much easier for these firms to sort of move across the border because the countries that they can choose among, right, provide many similar amenities for business. And so they don't choose to tax corporations very heavily. So relative to many countries, we have a relatively robust corporate income tax that we used to raise considerable revenue from. We find it harder and harder to raise revenue from it. Okay, so looking around the world, if we look at countries that are sort of lower income countries in terms of per capita income, we may also call these lesser developed nations. These are different terms for this sort of idea. We'll see one of the interesting features you'll see is that consumption taxes tend to make up a larger share of taxes in non-wealthy countries. Also that the prominence of border taxes is much higher in the poorest of countries. We used to be a country that used to raise revenue, considerable revenue from tariffs. And that was when we were a fairly young country. This is the late 1700s, the early 1800s. We used to have serious tariffs. And this is partly because a country will tax that which it has good records for. Right? Now, so a developing country where there is a large cash economy or a large black market economy or an in-kind, i.e. barter economy, there aren't records kept to keep track of wages and salaries like there are here, or we all get a W-2 at the end of the day. And so it's harder to sort of use that as a tax base. You tax that which you can count. So things coming in and out of a port are fairly easy to tax. You see them. It's a tax system that's easier to administer, right? Because how do you administer that tax? You put a guy at the port, right? And he counts stuff coming in, going out, and he assesses bills. You're also going to see, if we look at lesser developed countries, that sales taxes are a bigger deal, right? Because that's at least, you're trying to assess the income of every human being in the country. It's at least just businesses, right? And even in that, you can imagine that the smallest of businesses are not paying sales taxes on every transaction that they have. So tax administration in developing countries is actually a really interesting problem, and it's a problem which I think we need more good, smart people working hard on. Because I think the ability of a country that's developing to sort of invest in its people is partly conditional on its ability to raise revenue in an administratively efficient way, right? Okay, administratively efficient. We're going straight into the efficiency discussion. So I've shown you a few different tax systems, right? I've shown you what developing countries look like. We've talked about federal taxes in this country, state and local taxes. We've seen that they're different. We've talked about how Europe is different. We can see that they're different. But when we see things that are different, our natural question, right, is to ask, is one better? What does good mean, right? In economics, we have two bases for sort of judging a tax system. The first is efficiency. By efficiency, I mean that we're going to examine sort of the deadweight loss resulting from a tax. Deadweight loss is, in a sense, the excess burden. Remember what we talked about last time in terms of sort of deadweight loss. Deadweight loss is a measure, sort of the missing transactions. The transactions that some government intervention is preventing from happening. So the deadweight loss of the tax is one sort of inefficiency we're going to worry about. The second is another form of deadweight loss, but it's not going to be in our triangle exactly, but it's a loss as well, and that's compliance or administrative costs, right? In some ways, when a tax is very administratively complex, that's clearly a loss to the economy, right? Because those are man hours and resources being dedicated to sort of the compliance and administration of that tax. Compliance is what we're going to call the time spent by the taxee, right, the firm or individual paying the tax. Administration is sort of the cost of running the tax to the government, the cost of government of running that tax. Sometimes, there are taxes that the U.S. has, or many other countries have, that the tax may not be that huge in percentage terms, but it triggers a huge compliance cost, which is also sort of an additional burden the taxpayer and the economy as a whole is paying, right? Okay, so that's the efficiency angle. We're also going to judge a tax system based on equity. So one of the key contributions of economics to the understanding of equity and distribution is the notion that statutory incidence does not imply economic incidence. What do I mean by that? Just because one party is writing the check to the government, whether the government says, employer, you must remit half the payroll taxes burden for your employees, just because the employer is writing that check, it doesn't mean that they're bearing the economic burden of that tax. And that's because in the background, right, the market is going to re-equilibrate in light of the tax that's been imposed and reset pre-tax prices, right? Prices will adjust in light of the tax. And how prices adjust in light of the tax is what differentiates economic incidence from statutory incidence. Because the key to all of this, right, is that only people pay taxes. A firm can't pay a tax. That tax is borne by either the capital owners in that firm, the workers in that firm, or the consumers that buy the products of that firm. So it's either passed on in terms of higher prices to consumers or lower wages or returns to capital to the inputs of production. There's really no other agent involved, right? You can, if there are rents, you can imagine that in a rent industry that the taxes could impact rents. But by and large, we're going to talk about competitive industries, and the key to the whole picture is that only people pay taxes. Some input or consumer is paying the tax. And one thing I want to flag here that I think may help you as we sort of go on next week to talk about incidence in depth is that when we talk about efficiency, we're talking about quantity. We're talking about the change in quantity resulting from the tax. We're talking about the missing transactions that would have otherwise been made in the case of a tax, or that wouldn't have been made in the case of a subsidy, right? And the difference between the marginal cost and marginal benefit in that market, right? So the difference between those two lines, where demand is marginal benefit and supply is marginal cost. We're talking about Q. And why is P not part of efficiency? Actually, let's go ahead and I'll get there in a minute. So first, efficiency is about quantity, missing quantity, trades that don't happen. Equity, on the other hand, is about prices. It's about who is bearing the economic burden of this tax in terms of after-tax price. After-tax price paid, after-tax price received. This is what equity is generally about. And the reason why quantity is not part of the equity consideration, right? Because I'm sure a lot of you would imagine that, well, if these trades aren't happening, doesn't the number of trades that is missing matter for equity, right? The reason we don't think of it that way is that when we think about, I'm going to skip ahead to a demand curve really quick. We'll come back. Oh, too bad it's at the end. There we go. So just ignore the point of this, but let's focus on the graph on the left, right? So whenever we think of a demand curve, right, when we say that this demand curve is inelastic or elastic, right? This is actually what this graph is about. This is inelastic, that's elastic. The elasticity of, say, demand, right, has to do with whether or not the consumer of this product, so the consumer in this market, has a good alternative substitute for this good. The better the substitute for the good we're talking about, the more elastic demand is going to be. The more they're just going to buy that other thing for a given price change if prices go up. The more they're going to flood into this market if the price of this good goes down. So when we talk about there being missing trades, let's think about the deadweight loss, of any situation. The number of missing trades doesn't matter in a sense because we think of them as being indifferent at any of these prices to buying this good or buying the alternative, right? So it's not the missing transactions, but it's the economic burden, the economic incidence that determines equity. Any questions about that? This is a bit of, I'm sort of previewing next week's lecture, and I think setting this quantities, efficiency, prices, equity thing in your mind could really help you as we go down the line. Okay, let's back all the way up. All this fun stuff we have to get to. Okay, so when we talk about equity, what do we mean? When equity is our word for fairness, right, on some level, we could define equity in many ways, right? Because equity at the end of the day is sort of inherently tied to a value judgment. Are you utilitarian? Are you Rawlsian? Are you someone who weights certain members of society more than others, right? That's all social welfare function type stuff. And so equity is always a tricky thing. So let's sort of nail a couple concepts. Let's sort of find a language in which to describe our views of equity. So one way we're going to view equity is in terms of vertical equity, which is the idea that individuals with more resources should pay more taxes than individuals with fewer resources. So in a sense, a tax system can fall into one of three categories. The first being progressive, where sort of average taxes rise with income. So taxes are a larger share of income. That's what average tax means, right? Taxes divided by income as income goes up. You can have a proportional tax system where everyone's paying the same rate on every dollar they earn. So that would be that taxes are a flat fraction of income. And finally, you could have a regressive tax system where taxes are a declining share of income as income rises. An example of a progressive tax system here in the US would be our federal income tax, right? Our general ordinary income tax, which is progressive. We'll talk more about in a minute. A proportional tax we have is our Medicare tax, right? You pay the same fraction on every dollar you earn. A regressive tax in this country would be our Social Security tax, right? Which caps out at $110,000 in income, roughly. After that, you don't pay Social Security taxes on labor income anymore. So that would be a regressive tax, right? Because it's a flat fraction of income up until roughly $110,000. And then after that, the taxes you pay are flat while your income is going up. And so it's a smaller and smaller share of your income as income rises after $110,000. So vertical equity, we have, we talk about vertical equity sort of in the sense of talking about sort of average burdens. The second way we think of equity in economics is horizontal equity, which is the notion that people who have the same resources should have the same tax burdens, sort of irrelevant to what decisions they make in terms of lifestyle or even economic decisions. This is actually a much trickier thing to handle, right? Because what do we mean by people with the same resources? On a basic level, what we actually mean when we talk about it sort of in a functional way, the way we sort of use this term, is we mean people with the same income, right, is how we conventionally talk about this. The people with the same $150,000 of income should pay the same taxes to be horizontally equitable. But, resources could be defined differently, right? So I graduated from graduate school in 2010, and I came here and I started this job at Wagner, and I'm a professor here. I had a classmate who went on to do relief work in Kenya, right? Came out of my same program, admitted to the same program, spent the same number of years in graduate school and graduated. I had another classmate who decided to go work for a hedge fund. So our tax burdens, as you'd predict, kind of go, the highest is on my hedge fund friend, right? The average taxes he pays are the most. Then comes me. Then comes our friend who works in Kenyan poverty relief. But on some level, right, on some fundamental level, we were all screened into the same program. We're all sort of judged to have the same ability coming in. We were given the same treatment, right? We were given the same education for 5 years. And we sort of graduated with the same sort of ability to earn money, right? Ability to do something. So in some sense, we are being treated differently based on the economic decisions we made. If I suppose had another classmate, an imaginary classmate, who I didn't have, but imagine I did, who decided, MIT was great, this was fun, but I'm going to retire at 27. I'm good. I'm just going to loaf. It's going to be terrific. I'm not going to do anything. I'm never going to work. That person would pay the least taxes of all, right? On some philosophical level, it's not clear we think of them as having fewer resources than everybody, right, in my class, but sort of their tax burden does depend on a decision they made. So this is what I'm saying is this horizontal equity notion, we sort of make it functional by using income as the comparison basis of resources, but there's a philosophical bent to it as to what we mean by equal resources. Do we mean people who come from equal economic backgrounds, right? They were born as similarly well-off families who provided similar things for them. Do we mean twins should be treated the same by the tax system if they're identical, right? Regardless of what they do, they should be treated exactly the same. They're given the same nature and nurture, so we're going to assess the same tax burden on the two. It's a tricky question, and it sort of veers into philosophy, so I won't have much to say about that. But it's still sort of a harder question than it seems at first glance. Okay, so what do economists think of the way to sort of the most comprehensive definition of income that facilitates horizontal and vertical equity sort of considerations? Well, what we use in economics is called the Hague Simons comprehensive income definition. This is named after two guys, as you can imagine, Hague and Simons. This idea, this notion, this definition of income says that your income is your increase in your ability to consume in a given period. So your increase in your ability to consume in that period. So that includes any income flows you received from, say, your job, your wage and salary income. It would include any income you received on your savings, whether it be retirement or other types of savings, right? Because you could potentially consume with that interest. It would also include any change in the value of your assets over that period, right? Because you could always sell that asset, it went up that value, and you could use that change in value to consume this period, right? That's the change in your asset value that happened this period, and you can use that to consume this period. So we would include all that stuff. What else would we include? Well, we'd include things like fringe benefits from your employer. So NYU is kind and gives me health insurance. It lets me spend money on other things, right? Because I don't have to spend my salary income on health insurance. It's increased my ability to consume. I can consume other things more easily because NYU has provided me with this fringe benefit. The same would be true of cash and in-kind benefits from the government. So in some states, there's an asset test, right, to receive welfare. If you own a car in some states, you can't receive cash welfare. In some states, you can't be on Medicaid if you have earned income of this level. We'd actually want to look at every source of income somebody gets, right? Whether it's in kind or cash. This all increases a person's ability to consume. We want to add it all up. Because the idea that, because someone has a bunch of earned income versus someone else who has cash income should be treated differently for Medicaid purposes would violate horizontal equity, right? So this is about sort of treating all changes in your ability to consume the same. So we talked about net additions to wealth, but we'd also subtract off things that, while they could be counted as income in sort of your W-2 form, we wouldn't want to tax you on them because they're sort of inputs to your ability to earn income. So the cost of actually doing business or going to work, right? So if it's far costlier for you to get to work, imagine there are two individuals, one can hop on the subway, it's easy enough for them, the other person has some kind of disability that makes sort of navigating the subway extremely difficult for them, and they have to take cabs. We would consider those both the cost of getting to work, right? So we'd want to sort of let you deduct from your income the cost of actually earning an income. So using this more comprehensive definition of income improves both horizontal and vertical equity. In vertical equity terms, right, it treats people who have more resources, regardless of how they got them, differently, right? Because it says if you get health insurance and I don't, you're considered someone with more resources than me, right? That improves vertical equity. In terms of horizontal equity, it treats two people who get the same amount of resources the same, regardless if they get them in terms of wages and salary or fringe benefits and salary, right? So in terms of both horizontal and vertical equity, it kind of improves equity on both counts. But while we have, if economists came up with this handy definition of comprehensive income, why isn't it what even economists would think should be the basis for income taxes? Like many things in this course, reasons we deviate from something we would otherwise think is optimal often has to do with market failure. In this case, it's because of externalities. Externalities would lead us to want to use a different income definition than the Hague Simons income definition. So, make sure we didn't skip one. Okay, so we'll get to externalities in a minute. So let's go ahead and talk about we'll talk about externalities first for a second. So what types of externalities am I talking about? Well, your textbook talks about two kinds, right? That's the main two we'll think about here. The first one being a public good, right? A public good, like in the case presented in the textbook, say of homeless shelters. Why are homeless shelters a public good? Well, they're a public good in actually two senses now that I think about it. There's one sense in which we all sort of derive utility from the notion that the poor or the homeless aren't out in the cold and hungry tonight, right? That there's a homeless shelter, there's somewhere for them to go. We all sort of feel better about society because of that. And every dollar I contribute to a homeless shelter leads me to feel better, right? But it also makes you feel better because it reduces how many people are sort of out there. On some level, actually, now that I think about it, it's also sort of, it's a last option for everybody, right? So when I put $1 into homeless shelters, there's more homeless shelter capacity. If I myself were to end up in that situation, there's more capacity for it, right? And the same is true for you. I can't exclude you from benefiting in that insurance sense from homeless shelters. So there's a few different ways homeless shelters are public goods. But like all public goods, the private market will underprovide them relative to the social optimum. And why is that? It's because when I look at my paycheck and I divvy it up into different things, I decide how much to contribute to a homeless shelter based on my personal value of a homeless shelter, right? In terms of feeling better about the homeless not being out in the cold, in terms of any option value it has for me, I'm going to think about those two things and decide how much money to put into it, not taking into account that all of you derive benefit from it too. So it's a public good, and we might want to sort of increase private provision of it, right, because it's below the optimal level. And one way we could do that is through tax expenditures, right? So that's one externality motivation for a definition of income that sort of allows for the deduction of charitable giving. We want to let you deduct it from your income base and not pay taxes on dollars that you send to charity because we want to encourage you to do so. Because what are we really doing when we allow for a tax deduction for charitable giving? We're saying for every dollar you send to a charity, of that dollar, the government's going to kick in some fraction of it, in the sense that you're not going to pay those taxes to the government. We're saying. Another motivation, sort of for exclusions, right, could be that there's some kind of positive externality spillover. Your textbook has the example of home mortgages, right? We allow people to deduct the interest on their home mortgage because we think there is some positive externality to home ownership. That when you own a home in a community, you have some kind of long-term stake in that community. You care more about who your elected officials are, so you're more likely to vote. You plant prettier flowers. You're more likely to coach the youth soccer team, right? You might think differently about spending on schools and public resources. You might think differently about keeping an eye on the city treasurer, right, to make sure that he's effectively spending your tax money. All of these things we think sort of are triggered by having a long-term stake in your area, which is sort of correlated with being a homeowner. So we subsidize home ownership. We let you deduct your interest for home ownership. We think there's a positive externality, we subsidize it because there's going to be too little of that provided by the market relative to the social optimum. So these are two reasons for sort of having a different definition of income than Hague Simons. Okay, we'll come back to some of these examples further on in this lecture. Okay, so let's talk about the basic structure of the U.S. income tax. So this stuff is a little boring to you, I'm sure. It's not going to be super exciting, but I do think that knowing the vernacular here is useful going down the line, right? Because, I mean, not on the evening news maybe, but on cable news, for example, I sometimes hear these terms thrown around, above the line deduction, below the line deduction, right? I'm not saying this is this is sort of the wonky aside, but you do hear this stuff, and I think as students of public policy, this is good stuff for you to know. But I do think that sort of in the nitty-gritty of all of this, it may not be your first instinct of your favorite lecture to come in this course. Maybe the next 5 lectures won't be your favorite lecture to come. But I do think, in a sense, if only those who are naturally inclined to like this stuff care about it, it narrows the scope of discussion, right? There are fewer people participating in this discussion in an educated way. So bear with me as we get through this nitty-gritty stuff, and I promise you by the end you'll find it slightly more interesting. Not the end of today, the end of this half course, is you'll find it a little more interesting than you first thought you would. Okay, so the basic structure. You know, this slide's a little goofy. I will clean it up. So where it says adjustments, pretend it says adjustments / deductions above the line. That should be all combined into one. So how do we calculate your basic tax burden? We start off with your gross income. Your gross income is income from stuff like labor, right? Wages and salaries. It's your business income. That's from a partnership, the pass-through type of partnership. It's interest income. It's dividend income, which we'll talk about a little bit more in a second, about different kinds of dividends. It's all those sources of income added together, your gross income. Then we make your adjustments, also known as your above-the-line deductions. Your above-the-line deductions are things like contributions to tax-favored savings, i.e. IRAs, right? Which you contribute to your individual retirement account, you can deduct from your gross income, because we subsidize that stuff, because we think people do too little of it. So we can also deduct things like alimony, right? Things that are somehow not really income to you is the way we're considering this. That's your above-the-line deductions. At that point you take your gross income, you make adjustments to it, i.e. above-the-line deductions, and you get your adjusted gross income, your AGI. After your AGI, you're allowed to take your personal exemptions, which is sort of your cost of being a person. You get one of those for everybody in your family. So you get one for you. If you have a spouse, you get one for him or her. You get one for each of your kids. You get one for any elderly dependents you have in your home. If you care for your mother or father, you'll get one for each of them. And everyone gets one of these, but it's phased out for high-income people. If you ever hear the term PEP, it stands for personal income phase-out. So wealthy people get this phased out. I say wealthy, I mean high income. High income people, this phases out for them. So you get roughly $3,700, you get exactly $3,700 per person, and it's gradually phased out for the wealthy. That's this year. It'll go up with inflation each year. Okay, that's your exemptions. Now come your second set of deductions, known as the below-the-line deductions. So your below-the-line deductions can go one of two ways. You have the choice. You can either take your standard deduction, which is $5,800 if you're single, or $11,600 if you're married. That's one option. You can think of that as option A. Option B is to itemize. Itemized deductions are things like the interest you paid on your mortgage. So the interest portion of your mortgage. It's stuff like state and local taxes can be deducted below the line. So most people take the standard deduction. 65% of taxpayers take the standard deduction. Why do they take the standard deduction? Because they don't have enough itemized deductions for it to be worth their while. They get a bigger deduction taking the standard deduction. Some people itemize. 35% of people itemize. So do we think, so if you own your house and you haven't owned it for that long, you're very likely to itemize. Why do I say you haven't owned it for that long? Well, the way mortgages work, you're paying the interest. For the first many years, you're paying a lot of interest. So your interest deduction is very large. It's larger earlier on than later on in your mortgage. So people who own houses are more likely to itemize. They tend to be, of all people who own homes tend to be higher income. So itemizers tend to be higher income. And I said, what else is deductible below the line? State and local income taxes. So are we going to see more itemizers in states like New York or more itemizers in states like Idaho? New York, right? Why is that? We're a high tax state, right? We're a pretty high tax state relative to other states. So when we think about who, wants to keep the state and local tax deduction, it's going to be the good senators from the state of New York, the honorable senators from the state of California, Massachusetts, right? All these high tax states are where we really get the advocacy for keeping this. Later on in this class, actually in the last lecture before the midterm, we'll talk about state and local public finance. And we'll talk about sort of sorting models and optimality at that level. And we'll come back to talking about the state and local tax deductibility. Because in some sense, when we allow individuals to deduct their state and local taxes, we're subsidizing state and local taxation, right? Sure, paying your state and local taxes has reduced the income you have to pay your federal taxes, but do state and localities take your taxes and just throw them away? No, what do you get from them? Goods and services, right? You get public services. So we're sort of saying we're giving everyone a discount on their state and locally provided public service. It's an interesting question, we'll come back to it later. Okay, so you decide which deduction you take, standard or itemized, and then you get to taxable income. Okay, so let's go ahead and do a sort of neat and tidy example. Jack is a very typical taxpayer. At the end of class, we'll look at the tax return of a sort of non-typical taxpayer, but let's go ahead and start with Jack. So Jack's gross income, we can say this was wages and salary income or whatever it was $60,000. He put $2,000 into his IRA. He's saving for his retirement. So he took his $2,000 above the line deduction for his IRA contribution. Jack has a wife and 2 kids. He gets $3,700 of personal exemption for each of them. There's 4 of them. 4 times 3,700 is $14,800. So he gets to deduct $14,800 of personal exemptions. So I do want to note that when we talk about people being taxed, right, you aren't taxed on your first dollar of earnings. Everyone gets these exemptions, you get some deductions. At the very least, you're getting your personal exemption, right, and the standard deduction. So there's some income you get to hold on to pay tax-free. Taxes start sort of at, there is a 0 bracket for everybody, right, which is this stuff. You owe 0 taxes on this stuff. Okay, so let's get back to Jack. So $58,000 after adjustments. So his AGI is $58,000. He takes his personal exemption for him, his wife, and his 2 children. That's $14,800 of exemption. He actually paid, he owns a home. He paid $6,000 in interest on his mortgage. He paid $2,500 in state and local taxes. And he gave $500 to charity. So $6,000 plus $2,500 is $8,500 plus another $500 is $9,000. So if he itemized, he could deduct $9,000. He's better off with the standard deduction, right? The standard deduction, because he's married, is $11,600. He would take the standard deduction. You might notice if Jack was single, he'd probably take the itemized, right? He'd take the itemized. Question, I'm sorry, I can't remember your name. Arshi? Okay.
When you get your base of whatever,
Mm-hmm.
right, and they've already taken out your city and state taxes,
Yep.
then does that come back and, like, how does that work in terms of thinking like this together?
So at the end of the year, you're going to get this total of everything, right? So the state and local taxes is reflected, the deduction of your state and local taxes is reflected in your withholding, first of all, right? That's taken into account when they do withholding. And when you fill out your tax return, we'll do Mitt Romney's at the end, and you'll see exactly how it comes through. Is that okay if we just table it? Perfect. Okay, because you'll see it like in the nitty gritty. Yeah. Again, I mean, I am not a tax advisor in any way, but I can give you the bare bones, right? I will warn you now, we won't get the exact amount on that tax return when we do our kind of quick and dirty version that's on there. We'll get pretty close. We'll be a little bit off. Mitt Romney's tax return is 203 pages, and I read through the first few pages, right? So, and I figured, this quick reading of it got us pretty close and taught you enough about taxes and enough about why his rate is what it is, that the fact that it doesn't match up has to do with the fact that he has a very complicated income stream, and there are little bits and pieces that we're not going to actually take into account. So yeah, so we'll do something. I can answer your questions that are at this level that I talk about later, but I mean when it comes to like your individual foreign tax situation, this is not something I have any real knowledge of and should not pretend to. Okay, so Jack's going to go and take the standard deduction, which is $11,600. So his taxable income is $58,000 less $14,800 in personal exemptions, less $11,600 in below-the-line deductions, and so his taxable income is $31,600. I want to go back to this sort of vernacular I've been using of above the line, below the line. There's a big difference between these 2 types of deductions, right? Who gets to take advantage of the IRA deduction? Anybody who makes a contribution to their IRA, right? Regardless of whether they choose to itemize or not, they can go ahead and put money in an IRA and deduct that amount from their gross income. It's above the line. You don't have to decide whether you're itemizing or not when you take that deduction. The home interest deduction, on the other hand, is below the line. Do people who take the standard deduction get to use it? No, right? Only itemizers get to use below the line deductions. So when we decide where to put a deduction sort of in the tax structure, that's actually saying something about sort of the economics of this, right? About the equity of it. It's saying something about the efficiency. It says kind of which people are going to be distorted and which people will not be distorted by this deduction. So I can't remember. No, wait. Is it Eric with a K?
Yes.
Okay, terrific.
Thanks. I have a question. So for Jack's adjusted gross income,
Yep.
if his employer contributes to his IRA, does that impact his adjusted gross income? This is an accounting question again.
I don't think your employer can contribute to your IRA for you. They can contribute to your 401k. Your 401k, that's like a fringe benefit. That's like when you get a fancy healthcare plan and they just deduct that from operating costs on the business side, and you never see it. So, yeah. Does that make sense?
Yes.
Cool.
You pay for it later
When you take you're going to pay the sorry. So we'll get to retirement savings and I think lecture 2 weeks from now, I think, or maybe next week. I can't remember when you do it, but when you get to retirement savings, we'll talk about the nitty-gritty. The way retirement savings works, it comes in 2 flavors. There's 401ks and regular IRAs, where you don't pay taxes on them now. This is the kind of IRA we're talking about here, right? You don't pay taxes on it now. You don't pay taxes on your 401k contributions made by your employer, right? And then when you take the money out, when you take the distributions later, when you cash out, you pay the tax then. So if you think you're going to be in a really high tax bracket later, you're going to pay taxes at that bracket, right? Most people take this money out when they're retired, when their tax rates are pretty low. So it works out for them. But suppose you worry. Suppose you worry that you're actually going to be in a very high tax situation when you're sort of taking these distributions. Because some people, if you keep it for long enough, I think it's 70 and a half or something, you have to take forced distributions. So if you think you plan to work until 75, income tends to go up with tenure, right, with time. So you might be in a higher tax bracket then. You can opt for what's called a Roth IRA. There are some income qualifications for it as you put the money in, but a Roth IRA has a different flavor. You pay the taxes today, so you don't deduct it from your tax return here. You go ahead and pay the taxes on it. And then you get to take it out later, tax-free. And there are some ideas that, we'll talk more about this later. We'll get to it later. I won't bog you down with that stuff now, but we'll get to it in a future lecture. It's actually fun and interesting stuff. Okay, so any other questions about taxable income and any other stuff? Okay, terrific. So let's go ahead and talk about, so we have taxable income. When we have taxable income, we need to then figure out taxes. This is what the tax schedule looks like here at the federal level. On the left, we have your bracket structure if you're single. On the right, we have your bracket structure if you're married. There are other ways to file your taxes as the head of household or as married filing separately. The vast majority of Americans fall into one of these 2 categories, so that's what we're going to talk about today. If you ever have questions about sort of tax facts, there are a few resources out there. I mean, I hope all of you will one day visit the Tax Policy Center at taxpolicycenter.org. It's jointly run by the Brookings Institution and the Urban Institute, and it's just a panoply of great tax facts. Anything you want to know, they probably will be able to tell you. Every now and then, I want something that they don't have. I doubt any of you will want something so weird that they don't have it. But if that is the case, there are a few other sources which I also use, and you can find interesting things there too. One is the Joint Tax Committee, the Joint Committee on Taxation of Congress. It's a joint committee because it's a shared committee between the House and the Senate. They have some interesting stuff. They put out a compendium on tax expenditures every year. Another source is the White House Office of Management and Budget. They have the budget of the United States. So the data I used to put together those charts on corporate tax revenues came straight from their historical tables. So if you ever sort of need tax facts, these are all really good resources. Okay, so let's go ahead and get back to our bracket structure. So as I said, our individual income tax system is progressive. As income goes up, your marginal tax rate goes up. So this is taxable income, right? Taxable income over but not over. Not income, but taxable income. Because everyone gets their first piece of income, which is absorbed by their personal exemption and their deduction, their standard or itemized deduction. They get that tax-free, right? That's like the first 0 rate bracket. First bracket has a 0 rate. Then start these brackets. So if your taxable income is between 0 and 17,000, you're going to pay 10% of that in taxes. So if you have $15,000 in taxable income, your taxes owed is, anybody? $1,500, exactly. Your marginal tax rate in that case is going to be, if you earn $1,501, what's the tax rate you'll owe on that $1,500 first dollar? How much will you owe? 10%, right? Because your marginal tax, you're still in that first bracket. As long as you have less than if you earn $15,001, what will you pay on that $15,000 first dollar? 10 cents, right? You're in the 10% bracket. Say you earn $50,000 in taxable income. You have earned income such that you have income such that you have $50,000 in taxable income. What's your marginal tax rate going to be if you're married? If you're single, sorry. Oh, sorry. So if you're married filing jointly, let's go. Sorry, this is why it was confusing for you. So let's say you're married filing jointly. $50,000 is your taxable income level. What's your marginal tax rate? 15%. What's your average tax rate going to be? Some weighted average of 10% to 15%, right? Where the weights are how much income you have in those 2 brackets. Because when you have $50,000 in taxable income, you've fully exhausted that first bracket. So you owe $1,700 in that bracket, plus $50,000 minus $17,000, i.e. $33,000 at the 15% rate. So your average taxes will be the sum of 1,700, right, plus 33,000 times 15%. That make sense to everybody? Okay. So let's say you have $200,000 in income and you're filing jointly. What's your marginal tax rate? 28%. And your average tax rate will be some weighted combination of 10%, 15%, 25%, and 28%, where the weight on those different tax rates is simply the amount of income you have in each of those brackets. So it'll be 17,000 on 10%, 52,000 at 15%, right? Because you're exhausting all of these brackets, and then whatever remains will be in the 28% bracket. Okay, so let's get back. This is just an idea. So to give you a sense of sort of where the top marginal tax rate has been over time. So back in the day, but not that long ago, right? We're talking about 1945. Many people's grandparents were alive then, right? Heck, my parents were alive then, right? We see marginal tax rates at the very top in excess of 90%. This was an era where if you were at the top, for every dollar of income you earned, you kept cents on the dollar, right? You may not believe in the Laffer Curve, but you could imagine that this is a point at which we're sort of slowing economic activity. The value of effort is really kind of marginal at the top. Question? Your name?
Do you know what the top bracket was by any chance?
I don't. But you know who would know? Tax Policy Center. What's your name?
Diego.
Diego. Okay, excellent. Excellent. This is how I'll actually learn them, is when you actually say stuff. So, thank you, Diego. Yes, I don't know what it started at, but it was high. It was really high. It was, yeah. This was the top bracket wasn't touching the vast majority of Americans. Like a doctor wasn't paying this rate. No. This was some kind of rentier. Okay, so we saw tax rates are really, really high, and then they come plummeting down, right? One of the times they come, there's a huge change, is in the early 1960s. That's Jack Kennedy's doing, right? So John Kennedy brought down marginal tax rates by a bunch. Because the thing is at that higher rate, it's not clear you're raising that much revenue, right? So he brought tax rates down. They bobbled around a little bit. We see the next reduction in the 80s. One of those reductions was part of what's known as the Tax Reform Act of 1986. It was passed, under President Ronald Reagan, along with Congress, right? And it was a compromise tax plan. It was a tax plan that had to be a tax reform that had to be revenue neutral. And one of the ways they actually paid for the fact that individual income tax rates came down so far, and the package in whole was revenue neutral, is that they increased corporate taxes. They didn't increase corporate tax rates very much. What they did is they filled in the corporate tax base. There were a lot of carve-outs and loopholes and deductions and credits on the corporate tax base, and they filled it in, so that the similar rates applied to a more solid base led to more corporate taxes. So they paid for this rate change by increasing corporate taxes, basically. Okay, let's get back to Jack. So we're going to calculate Jack's taxes owed. We said that Jack has $31,600 in taxable income. If we go back to our married filing jointly rates, we see that he is in the 15% bracket, right? So he's going to owe the full $1,700 because he's maxed out that first bracket. His income exceeds that first bracket. And then he's going to owe the difference between $31,600 and $17,000, right? That's his piece of income that's taxable at the 15% rate. And that's his marginal tax, right? So it's going to 15% times $14,600, which amounts to $2,190. So his total taxes owed is going to be $3,890. But we're not done yet. We have not done tax credits yet. Any questions about this so far? It's okay, don't be embarrassed. If you have a question, I promise you someone else has it. Okay, so we're not done yet. This is taxes owed. He's going to offset some of his taxes owed with credits. So tax credits are amounts that can be subtracted from taxes owed. So when I give you, let's go back a little bit. So when I give you an income tax deduction, so if let's say your marginal tax rate is 25%, and I say, you know what, you can deduct this dollar of income from your taxable income, how much am I saving you? You can deduct $1 from your taxable income. Your marginal tax rate is 25%. How much are you saving? 25 cents, right? Because all you're getting to do is not pay taxes on that dollar. You're saving the taxes owed on that dollar of taxable income. So when I give you a deduction, your savings rate is tau, your marginal tax rate. That's what you're saving. On the other hand, if I say, you know what, I'm going to give you $1 of tax credits, you get to reduce your taxes owed by $1. So how much do I save you when I give you $1 of tax credit? $1. So if I offered you a dollar deduction or dollar credit, which do you want? The credit, right? Because you save in dollars rather than in tau times dollars. In general, later on as we go on, we're going to talk about tau in terms of labor supply and stuff. We're talking about the marginal tax rate. That's what tau generally is. And I'll say that again when we get to it. Okay, so tax credits come in two flavors. There's refundable tax credits and non-refundable tax credits. Suppose you have a situation where an individual has $1,000 in taxes owed, but they have 2 kids, and let's say there's a $2,000 tax credit that they're eligible for. They only owe $1,000 in taxes. If the tax credit isn't refundable, how much will they pay in taxes? 0, right? Because 1,000 minus 2,000 is a negative 1,000, but you can't have a negative liability in a non-refundable credit system, so you just don't owe any taxes in that situation. In the case of a refundable credit, if you have insufficient taxes owed to fully absorb the credit, you get the difference as a refund. So in the case of you have $1,000 in taxes owed, and you're eligible for a $2,000 tax credit, the government will send you a check for $1,000, because you can get a refund on that. Okay, so let's go ahead and okay, and the other thing, so this is tax credits. This is always a very controversial topic. Oh, I can't remember your name. David, yes.
Sorry, before we go too much farther, so I know we're going to do Romney's return, but he is well over the 35% bracket. So basically, his first 17,000, he's only paying 10% on, and then his next bracket, that amount he's paying 15% on, and so forth, all the way through.
Everyone gets the first few brackets. So he actually ends up paying the AMT, so he doesn't get his full phase-outs and his deductions and stuff. Okay. We'll get to that a little bit later. But let's leave Mitt Romney aside for right now. Let's talk about just a person. Let's go back to these brackets for a second. Let's just talk about a couple that makes $500,000 in taxable income. It's $500,000 in taxable income. Let's just say it's labor income. There's nothing particularly complicated about this. They're making lots of money. They're not making Mitt Romney money, right? They're not triggering the AMT yet. Let's say that they don't have a lot of deductions. Their taxable income is $500,000. They get to pay 10% on their first $17,000 of income, 15% on their next chunk. Everyone gets their bracket discounts on the way up. Yeah, and so this is why when people think that their marginal rate is their average rate, they're wrong, right? If someone who makes $200,000 thinks they're paying 28% in federal income taxes, they don't know how to divide, right? That's the situation there, right? This is the difference between marginal and average tax rates. I'm ashamed to say that I remember liking the show The West Wing, and it sort of hurt my sense of it when I remember even that show confused marginal and average tax rates. I think it may have done it twice, if I recall correctly. So I think Aaron Sorkin is a smart man. He probably needs to come take the first half of this class, right? Marginal and average tax rates are two different things, and we'll talk about what they each signify in a couple slides. There was a question, you in the blue sweater? Did you have a question? Yeah.
Yeah, just going back to the refundable.
Yep.
Give an example?
Yes. So there was a big fight about the child tax credit. A child tax credit is a tax credit for having a child, right? If you have a child, you get the tax credit. But some families don't have enough taxes owed. If you have 3 kids, that's $3,000 in tax credits. Some families at the end of the exemptions and the deductions and all this stuff don't actually owe that much in federal income taxes. They've paid a lot in payroll taxes, and that's not part of the schedule that we're talking about here. That's a separate tax system. But so they don't owe more than $3,000 in federal income taxes, and so they weren't benefiting from the expansion of the child credit that happened in the 2000s. And there was a very large fight about how much of that credit should be refundable. And so the child tax credit is actually partly refundable. The earned income tax credit is fully refundable. It has to be. The whole point of it is to subsidize your wages, right? So that's a fully refundable credit. Some credits are not, some credits are. It sort of just depends on the provisions of the credit and the budgetary situation when that credit was passed. Often has something to do with it. Terrific question. What's your name?
Gaiva.
How do you spell it?
G-A-I-V-A.
Gaiva. We've had this before. G-A-I-V-A, Gaiva, got it.
It's with a D.
Okay, I clearly am just hard of hearing. Gaiva. Terrific. Okay, great. Okay, so that's tax credits. Let's talk about withholding. So withholding is the system by which the government collects your taxes all along the way during the year. Instead of sticking you with a tax bill at the end of the year that you may not have saved adequately to pay for, right? That's a real risk. for some individuals that they may not have set aside the money to pay their taxes at the end of the year. The government collects part of its tax bill all year long. It does this on wage and salary income. It doesn't do this with capital gains. It doesn't do this with other kinds of investment income. But with wage and salary income, it does because it's all easily recorded and easy to trace, and you owe it it's year by year. So the way this works, if you have some faint memory of your first day of your job, you filled out some paperwork about withholding and how many exemptions, et cetera, et cetera. That information is used to sort of figure out as best we can, based on that stuff, what your tax bill will be this year, right? That's what's sort of done, and that's the amount withheld each period. At the end of the year, this is rarely done correctly, either because we forget to update that form each year. People have a kid, things change, and they don't update that form, so their withholding is wrong, or they weren't that good at it when they filled it out. They didn't remember all the things, and some people purposefully want withholding. Some people, a large number of people in this country get tax refunds each year. A tax refund is an interest-free loan to the federal government. In this interest rate environment, it's not a huge loss, right? But even in the 70s, lots of people were getting tax refunds. A time in which, the worth of a dollar was eroding as we watched it, right? Inflation was very high. A tax-free loan to the government was a costly thing. People get tax refunds, and it's one of these questions as to why this is, right? Rationally, it doesn't make any sense. Even if it's 2% interest, why not have the 2% instead of giving it to the government? There's a few different explanations. People are inertial. They find it extremely costly to go find the HR person and fill that paperwork out again. Some people think that folks use their tax refund as a forced savings vehicle. Like it forces them to save each month in a way, and then they get that refund check when they file their taxes, and they just put that in a savings account. They can somehow force themselves to do that, but they can't get themselves to put money in the bank every month. Whatever the explanation is, a lot of people get tax refunds. And that's because our withholding system isn't perfect. We sort of go by what you tell, the federal government goes by what you tell them, and they sort of follow that pattern all year. Reasons why withholding may not be perfect, we said you may have filled that format wrong, you may not have changed it when things change in your lives. Sometimes people get a promotion and they make more money, right? Sometimes people lose their job and they make less money. For all these reasons, withholding could be different. It could be wrong, it could be off. In the US, we reconcile this when we file our tax return, right? This is when we calculate what our taxes owed were, we look at what was withheld, and then we write a check or get a check for the difference. In other countries, for example in the UK, the government uses all the information it has on you, right? It has what your pay is each period, right? And how that's evolving over the year. If you're making more money than expected or less money than expected. It knows what you put on your return last year, right? It knows that you had 3 kids under the age of 18 last year. Odds are you're probably going to have 3 kids under the age of 18 this year, right? It knows their ages. You fill all this out. Things, of course, change. People get divorced, et cetera, et cetera. But by and large, they kind of know what your structure is like. So in the UK, as the year goes on, the withholding dynamically changes. They adjust it each month, such that at the end of the year, you don't have to really fill out the paperwork and calculate your taxes. For most people, it works out. Of course, you want to check it and make sure it's right, but you don't have to file a return the same way that we do here. The government sort of does it for you. We don't do that. Everyone fills out a return each year in this country, right? Whether you're Mitt Romney or you're me or you're a person, every person walking around in America fills out a return each year. Valerie?
Is this cost effective? Like, is this compared to the states? The burden is on the individual.
For the government, it's very automated, right? Like at some point, money was spent to create an automated system that fed all this in. But it's probably more efficient to have it centralized than, I know I spend time on my taxes. I'm sure we all spend some time on our taxes. We all know what we make per hour. The tax system is it's very costly, right? It's probably more administratively and compliance efficient to have what the UK does. But we don't have that for a few different reasons. First of all, we're a different country than the UK, right? We just have very different feelings about what we want the government to do for us and what we don't want the government to do for us, right? We're different. They have centralized healthcare, we don't. We differ in many, many ways. There's also an argument that, in the UK, people don't really interact with the tax system very much anymore, right? It kind of happens in the background of their paychecks, and the government does all the figuring for them, and it's sort of, they don't really feel it anymore. They don't see it, they don't touch it. It isn't something they deal with. And some people feel that kind of lack of interaction can lead to a sort of a non-salience of taxation. That when taxes go up, people don't feel it as much. And some people feel like that's not right. that people should have an interaction with the tax system that helps them understand what they're paying. And so that's part of it. But it's just a very different system, and it's interesting. Some people propose it here. We'll see if we ever get it. Okay, so let's get back to Jack. So we said Jack owed $3,890 in taxes before credits. Let's go ahead and check out Jack's tax credits. The only tax credits Jack is eligible for is the child tax credit. He has 2 kids at $1,000 a pop. That's $2,000 in child tax credit. $2,000 in child tax credits. So $3,890 less $2,000, Jack owes $1,890 in post-credit taxes. But he looks at his W-2 and he sees that $2,000 has been withheld over the year. So Jack is going to get a tax refund of $110 from the federal government. The government is giving back his own money, right? He over-withheld is giving him back his $110 that was over-withheld over the course of the year. $110 is actually a pretty small refund as refunds go, right? People are often having a lot more over-withholding as a fraction of their income than this. Okay, so let's talk a little bit about marginal versus average tax rate. I said that anyone who is making $200,000 in taxable income and thinks they're paying 28% isn't doing math, right? They're reading a chart incorrectly. And that's because average taxes, right? So your marginal tax rate is what your next dollar of income would be taxed at, right? So if we look back at this set of tables, your $140,000th dollar of taxable income is taxed at a 28% rate. Your marginal tax rate would be 28%. Your average tax rate, on the other hand, is total taxes divided by your income. I will tell you that the notion, I think average taxes is a slightly ambiguous idea because what the denominator is sort of up in the air, right? Do I mean what the taxes are is clear, right? In Jack's case, it's $1,890. The numerator is a fixed idea. But when I say your average tax rate, do I mean dividing by your AGI? Do I mean dividing by your taxable income? Do I mean dividing by your gross income? Right? So if I ever ask you for this number, I will tell you what I mean. It should go in the denominator. Because I do think it's a bit of a fuzzy idea. And sometimes you hear people say statistics in the news that it's not precise as to what they're dividing by. There's no standard definition. Okay, so when we think about these two concepts of tax burden, or taxes, average tax rates convey the tax burden this person feels, right? It's how much of their income is being sent to the government in the form of taxes. That's average taxes, average tax rate. When we think about how this person is allocating their time between labor and leisure, in the case of labor income taxes, or between pears and bananas, in the case of banana excise taxes, what tax rate is relevant there? The marginal, right? Because it is what impact the tax policy has on their marginal decision to consume or to work. If Jack has worked 2,000 hours, what's relevant to his decision to work a 2,000 first hour is how much of the earnings from that hour he would get to take home, right? The net increase in income from that additional bit of labor supply. And what matters there is not what average taxes he's paid on his 2,000 hours of labor. It's what tax rate he would pay on that 2,000 first hour of labor. What he's paying on his 2,000 hours of labor tells us what burden the tax system exerts on him. When he thinks about what to do with this 2,000 first hour, law and order, or work, it's the marginal tax rate that's relevant. Does that make sense to everybody? Okay, so just to get a sense of what marginal tax rates and average tax rates look like for different folks in the income distribution, if we take a look at sort of the dark blue line above and this sort of medium blue line that's second from the bottom, the dark blue line is the marginal tax rate of actually, you know what, let's do the other two first. Let's do the sort of medium blue line that's second from the top and the bottom line, the bottom sort of turquoise line. So the turquoise line shows us the average tax rate of the median income family over time. So it's the median income family in each of these years. So what median income is changing over time, right? As society gets wealthier, it's going up. But it's the average tax rate paid by the median income family, the family right in the middle of the income distribution. As we can see, it's had some sort of changes, right, the average tax rate. We see a lot more change in sort of the medium blue line that's second from the top. That's the marginal tax rate. We can see the median family benefited a lot from the Tax Reform Act of 1986. As Diego asked, right, we can see that the changes in the 60s did not affect the median family all that much, right? Those high tax rates on the very top people that were brought down a lot did not really affect the median family because they just weren't in that bracket. That bracket started very high. But we can see the 86 Tax Act did affect sort of a median family's marginal tax rate. Did it really bring down their average tax rate very much? Not that much. They felt some benefits. They got a tax cut for sure, but it wasn't as big as the change in marginal rates. So a tax reform like the Tax Reform Act of 1986 didn't change the burden of the tax system by very much. I mean, it did a little, but it wasn't that big a change. What it did was it changed the disincentives of the tax system on the marginal dollar of income because it brought marginal tax rates down for the median family, right? It made an extra hour of labor supply more attractive to the median family than it had been before by a wide margin, right? Because before their tax rate was somewhere around 22%, right, in like 1985, and it came down to roughly 15%, their marginal tax rate. So the fraction of their marginal dollar of earnings they got to keep went down by 10, what they got to keep went up by 10 percentage points. That's a large change, right? The average tax didn't change that much, but the marginal tax rates changed a lot. Okay, let's look at a family that's at twice the median income, which is the dark kind of navy blue line at the top, and the line that's second from the bottom, the sort of pale blue line that's second from the bottom. So the pale blue line, second from the bottom, is their average tax rate. We can see that their average tax rate, so if we look at average taxes between like 2000 and 2003, we can see the average tax rate of a median income family, twice the median income family, fell a lot, right? Thanks to the 2001, 02, 03 tax cuts. So their tax burdens fell significantly. When we look at their median tax rates, those seem to go down too, right? There was more tracking for that tax cut for a family that's higher in the income scale. Keep in mind, a family at twice the median income was not, rich is a relative term, right? Something we argue about all the time. Who is middle class? Who is rich? Twice median income is not astronomical, right? That's, depending on where you live in the country, it could be, New York, twice national median income is not particularly high, right? Like it doesn't go that far in the city. So these are not exorbitant numbers. We're not talking about, we're not talking about the super wealthy in any realm here. We're not talking about their marginal tax rates at all. Okay. Okay, so that's sort of the end of nitty-gritty tax stuff for now until we get to the tax return later. Any questions about the nitty-gritty of calculating taxes? Your name?
Amy.
Amy, go ahead, please.
Earlier you mentioned that, so Jack is getting a refund of $110, but that's from the federal government,
Yep.
not from state. State was already deducted somehow, or I don't know.
So what happened, the only thing we've talked about state and local taxes is that he's paid some state and local taxes to his state and locality, and he gets to deduct what he paid from his federal income taxes. He separately will file his state and local taxes to the state franchise board, as it's called in California, the state of New York here. So those are separate tax returns he has to file to his state government, to his local government. Kelly, do you have a question?
Yeah, is there a quantity for wealthy? Like when we talk about the wealthy, or I don't think people use class system anymore, but is it like 200,000 income or up?
Well, this is the great debate, my friend. This is the great debate.
I'm sure if the government used like.
I mean, the government is different people in different times, right? And that definition might change with them. It might change with how society changes, right? Like since sort of 1980, we've seen a large change in the income distribution. The very top of the income distribution is pulled away from the middle, right? However you feel about that as a values thing, that's up to you. But that might change how we view someone at any given level of income, right? Depending on what the income distribution looks like at a period of time. I think right now we often hear a phrase used in politics when we hear politicians talk about taxes that if you make less than $250,000, right, is something we hear a lot. Is that where rich starts? I have no idea. That's where something starts. That's where maybe your taxes changing is okay. And maybe that's a distribution of votes, right? Is different at 250,000 or not. I mean, I don't know. This is sort of the $1 million question, I think, when it comes to these types of equity discussions in terms of practicality. There's no number for where rich starts. Because I mean, $250,000 in New York City is very different than $250,000 in rural Iowa, right? Because what's one of the real huge differences between these areas? Real estate costs, right? How far a paycheck goes is very different in the state of New York, partly because our rental costs are very different. We were talking about how welfare benefits vary by state to state. That's partly because of real estate differences, right? Cost of living is different in different places. So, I mean, there's no number. And I can't imagine there ever being a number, right? It's just...
It's hard because like now it's like the 1%, and that's like people, and then the 0.1%, and that starts I think at like $200,000, and so isn't that right?
No. You know what? I don't have the census with me, and I don't think there's any point to guessing at these numbers publicly, so I think, pull up the census, go home. I mean, just go to census.gov, just go look at this. I mean, what I would love for you guys to feel coming out of this class is that this age, questions are answerable. You shouldn't be afraid of going to the BLS website and looking it up. It'll literally take you 4 minutes. Okay, the first time it'll take you 6 minutes. You don't know how to exactly navigate that website. But I would love for you all to put in the fixed costs of navigating all these government websites so that when you have random questions like, where does the top 5% start? Don't go to the New York Times. Like, there's no reason for that. You can go to you're smart, educated people with masters, right? You should be able to find this. It's easy to do that. All these government websites have actually created user-friendly systems. Sure, it'll take you 2 minutes to figure out where the data is, but it's something I'd love for you to walk out of here feeling like at work when someone asks you a question, you're the person who pulled it up on your iPhone, right? Because you know the census website. You can do it. I promise you. I mean, conversations with my friends are probably a little census-oriented, but we do it on our phones, right? I mean, this is not difficult to do. It's simple, it's easy. It's about just doing it twice, and then you own it. So Kelly, if you have the time, why don't you look into it? Terrific. Yeah, no good deed goes unpunished. Okay, terrific. Let's get back to class. Okay, so tax expenditures. So one of the things I'd really like, another thing I'd like for you to walk away from is the notion, walk away from this class with, rather, is when we say tax expenditures, it's just another kind of spending. It's spending through the tax code. It's in no way sort of somehow fundamentally different than general spending. Some of the incentive effects are different. We'll talk about that in a minute. But when it comes to sort of the budget deficit, tax expenditures and spending are still dollars coming out of the federal government, right? So we call tax subsidies, another word for that is tax expenditures. It's government revenue losses due to exclusions, deductions, and tax credits. So I try to think of sort of the full tax base as a big block of cheddar cheese, right? Or cheddar cheese that looks like cheddar cheese, right? It's big, it's heavy, it's solid. And then we sort of look at this tax base and we find reasons to come over and carve out these sort of cylinders, right, of cheese right out of it. These are things like, you know what, we want people to own homes. Let's have a home mortgage interest deductions. We want firms to engage in more R&D. Let's have a tax credit for research and development. Each of these things, while most of the time are well motivated, right, there's nothing nefarious about the R&D tax credit. There are economic arguments for it. There's not something really deeply nefarious about the home mortgage interest tax deduction. There are real arguments in favor of it. But we come in and we pull out all of this cheese, right? And what once looked like cheddar cheese ends up looking like Swiss cheese, right? It's got all these holes, and it's not as effective a base at the same rates for raising revenue, right? Because there's all these carve-outs. And all of those holes are tax expenditures. It's revenue we're no longer taking in because we've decided to differentially tax some activities, some income, et cetera, et cetera. So what are the rationales? Why do we take the cheese out of the base? There's a few different reasons. First of all, there's the cost of earning income, right? This is the reason why, some types of business travel that you're doing for your partnership or something is deductible, right? Cost of, if you have to drive very far for your work for some reason, some of that's deductible, right? So cost of sort of earning a living. If you have to relocate for your job and your company is not sort of absorbing those costs, the portion that you pay for can be tax deductible. So that's one reason cost of earning income is one rationale for tax expenditures. Another is uncontrollable losses that affect your ability to pay. So if you experience a fire, right, you're worse off in a way that, is not your fault. Random events happen. We don't want you to have to owe taxes on the income you earned this year that you have to now dedicate to sort of making yourself whole when it comes to your fire. If we have a tax deduction for very high medical expenses. So if your medical expenses amount to more than 7.5% of your AGI, you can deduct them. Right? And that's because we want to make sure that it's not, I thought it would be fun to get a nose job, right? It's more, it's a very large scale medical expenditure. So, if your child is very sick and your copay is enormous, right? Even, there's always many insurance programs have a 10, 20% copay for even large medical expenditures. That share of your income that you dedicated to that, you're shielded from, right? Or maybe you don't have insurance, and so it's a very large healthcare expenditure. And we think large expenditures tend to be more uncontrollable, hence the threshold, right? That it's hard to spend, $100,000 in medical care by choice. As we'll talk about later, there does seem to be elasticity when it comes to medical care consumption. So maybe this tax deduction is creating marginal spending, but at least we'd sort of limit it to only those who have very high expenditures. And then the last reason is positive externalities. which we've talked a bit about already, right? That there is some type of public good provision we're trying to encourage by the private market, or that there's some type of spillover from some form of spending that we're trying to encourage. When we do have the idea of externalities as our motivation, whether it's a public good or a spillover, there's sort of two impacts our creation of a tax expenditure will have. It'll have a marginal impact and an inframarginal impact. So a marginal impact is the change in behavior induced by the tax incentive. So in the case of charitable giving, let's imagine that we have with no tax expenditure, we'd have, say, $50 million of charitable giving. Let's say if we allow a tax deduction, we get $70 million of charitable spending. Sorry, millions, these billions probably. $50 billion of charitable spending versus $70 billion of charitable spending, right? That $20 billion increase in charitable spending is the marginal impact, because it's what our tax expenditure is getting us in terms of behavioral change. We're getting $20 billion in additional charitable giving. The inframarginal impact is the tax loss from subsidizing behavior that would have taken place anyway. So when we start allowing people to deduct their charitable giving, sure, we're getting $20 billion of additional charitable giving, but we're giving tax breaks on the $50 billion that would have been done anyway, right? Say our average tax rate is 20%, our average marginal tax rate, let's say, across people is 20%. So our average expenditure, right, our average tax expenditure for the $50 billion that would have happened anyway is $10 billion. Our marginal impact is $20 billion of new charitable spending. Our inframarginal impact is the $10 billion we're losing in tax revenue for the spending that would have taken place regardless. Does that make sense to everybody? So when we think about tax incentives, what we often want to get is the most bang for our buck, right? Where bang for the buck is sort of the marginal impact to the inframarginal impact. A policy change that would create a large behavioral response that would trigger lots more of the things we like, right? And doesn't cost us a terrible amount of revenue is a winner. Is a tax incentive that's getting us something for low cost. So this is another example. So you can go through this on your own. I've just given you a different one verbally. Okay, so let's talk about the charitable giving deduction again. So this is something, so how many of you are taking stats 2 or estimating impact? So if I say, don't look at the slide, just don't look at the slide, because it's not right. Don't look at the slide. If I tell you that the elasticity of charitable giving with respect to the tax rate is 1, or is -1, what am I saying, what does that mean in a sentence? Can anyone tell me? If I tell you that the elasticity of charitable giving with respect to the tax rate is -1, what am I saying? Okay, I'm going to do it just because I want it to be done exactly right. I just realized this is something I want to say exactly right, so I'm going to do it. So when I say that elasticity is -1, I'm going to do it just because I want it to be precisely what I say it is. What I'm saying is that a 1% change in the tax subsidy, let's say, triggers a 1% change in charitable giving. And if it's -1, what I'm saying is if we increase the subsidy by 1%, we get, with respect to the tax rate, sorry, I'm saying this backwards. So let's say the elasticity of charitable giving with respect to the tax rate is -1. What I'm saying is if we increase the tax rate by 1%, no, this is entirely backwards. So it's 1. It's +1 because when we increase the tax rate, right, we're increasing the subsidy to charitable giving if it's deductible, right? So it's a positive elasticity. We increase the tax rate by 1%. We're increasing the subsidy on charitable giving, and we get 1% more charitable giving. So an elasticity of 1 implies percent to percent of 1. A 1% change in the tax rate gives us 1% more charitable giving. Does everyone follow me?
1% increase
in the tax rate gives us a 1% increase in charitable giving. Because as the tax rate goes up, the subsidy to charitable giving is going up, right? Because the share of the dollar that you send to charity that the government is paying is going up, right? Everyone with me on this? Okay. Anyone confused by the sign? I clearly was for a second. It's okay if you were. Okay, you're all smarter than me. Okay, so it's a 1% increase in the tax rate gives us 1% more charitable spending. that does not mean a $1 increase in the tax credit gives us an additional dollar of charitable spending. Why is that? Because elasticity is in percent terms, and those bases are two different numbers, right? Right. So if the tax rate is 30%, a 1% increase in the tax rate increases the tax rate to 30.03%, right? We're saying that that triggers a 1% increase in charitable giving. If charitable giving is $500 million, that's an additional $5 million of charitable giving. You see how this is not a dollar for dollar comparison? That's the definition of an elasticity. Sometimes in Gruber's, you will say the elasticity is 1 or -1, and then say that that means that a dollar more of one thing gives a dollar more of the other thing. I think that's a sleight of hand he does, because he does it repeatedly, and he clearly knows what the definition is. I think it's a sleight of hand he uses to make the textbook more readable to undergraduates or students who have not taken statistics, have not heard this terminology. But I think I want you guys to understand that there's a sleight of hand there, right? An elasticity is percent to percent. These things have different bases, so it's not a dollar for dollar. But let's just say, for the sake of exposition, that a $1 increase in the tax credit gives us a dollar of charitable spending. Are you ready to pretend? Everyone with me? Everyone with me? Okay, that's what we're going to say. Let's pretend that is the response of charitable giving to tax deductions. So an additional dollar of tax subsidy gives us $1 of charitable giving. Okay. Other empirical work suggests that when we actually publicly provide goods for charity, we have a crowd out of between 10 to 70 cents. So when the government puts a dollar into homeless shelters, private individuals reduce their spending, their charitable contribution to the homeless shelters by between 10 and 70 cents. So in the second case, so let's go back to the spending thing for a second. So when I say that a dollar of public provision, right, so public spending, government spending on homeless shelters reduces private contributions by 10 to 70 cents, that's a way of saying that government provision crowds out private contributions by 10 to 70 cents for each dollar of public contribution, right? Because what happens with crowd out, right, is that we all get utility from the existence of the homeless shelter. If government is putting a dollar into it, we all reduce our spending on it because a dollar is being put in anyway, right? That's called crowd out. There are examples of crowd in, right? Suppose there were really high quality free healthcare clinics all over New York City. Would we all have health insurance? We'd all crowd into the public thing, right? So there's various examples, but this is an example of crowd out, right? We're going to reduce our spending on homeless shelters because of the public provision. With tax expenditures, we have crowd in, right? Because what happens when we say of every dollar you contribute to charity, the government's going to contribute, say, 25 cents if that's your marginal tax rate. You're going to spend more on charity. You're going to crowd into charitable spending, right? And whether one is better than the other has to do with the level of crowd out versus crowd in. We're saying in the top line, right, when you say dollar for dollar, what we're saying is that for each dollar the government gives you in tax subsidies, you're spending an additional dollar on homeless shelters. When we say there's a crowd out of government spending, we're saying that the net impact of a dollar of new spending by the government on homeless shelters only nets us between 90 to 30 cents of new spending on homeless shelters. Because the government puts in a dollar and the private sector reduces their spending by between 10 cents and 70 cents. So it's 10 cents, it's a dollar of public spending, 10 cents less of private spending, 90 cents of new spending, right? If it's 70 cents, it's a dollar of public spending, 70 cents less of private spending, only 30 new cents going into homeless shelters. So we have to compare these two numbers. In this case, if we had to choose as a government whether to put an additional dollar into tax expenditures or public provision, which is the more effective way to increase net spending on homeless shelters? One gets us dollar for dollar, the other is getting us somewhere between 90 and 30 cents. Dollar for dollar tax expenditure, right? Because the sensitivity of crowd in to tax subsidies is better, right? People seem to be very sensitive in terms of crowd out to government spending. The tax expenditure is the better bet. Is this clear? Because what we want to compare is net new spending on the public good we're talking about. Yes, your name?
Jessica.
Jessica, yes.
It says 1%.
Yeah, this is what we talked about in the beginning. It's always, I will fix this slide, and it's just going to say a dollar for dollar. I flagged this because I want to talk about elasticities, the way it's discussed in the textbooks. I think it can be confusing for those of you who are in metrics of some kind. This is exactly what we just talked about. Okay, terrific. So the one thing I want to highlight is one of the other reasons to maybe favor one over the other is sort of the information and preferences that are reflected in the spending, right? So when the government puts $1 into homeless shelters, who is the government, right? Whoever's administering the department that's responsible for homeless services, right, is deciding where that dollar goes. In the best of all worlds, that agency is reflecting our collective social welfare function and sort of correctly sort of providing dollars to shelters that reflect everyone's preferences in some aggregate way, right? But there are a lot of reasons to believe that that's not exactly happening. And second, even aggregating our preferences is a very difficult thing to do, right? So there's a lot of reasons to believe that where the government would put $1 would be somewhat different than where individuals would put their fractions of $1 collectively. So one thing by allowing tax expenditures to sort of fund spending for charitable purposes rather than government spending, right, is that when we allow people to just deduct their spending from their taxes, they can put their money where they most want to, given their preferences, right? So it reflects their individual preferences, and also potentially given their personal knowledge of the effectiveness of different charities, right? That they might have some information about how well a charity works, or they might have a lack of information about how well a charity works, right? It could go both ways. But it's going to reflect both your preferences that are private and your information that's private. And sort of how much weight we put on those two factors will determine whether an expenditure sort of is the more effective way to do it as well. It's sort of this crowd in, crowd out comparison, as well as how much we care about sort of consumer sovereignty in a sense, right? For example, with the case of charitable giving, I'll get you in just one second. Matt, right? Yes. I'll get you in just a second, Matt. So in the case of charitable giving, a lot of charitable giving dollars actually go to religious organizations. And they have to meet some tests in order to deduct your charitable giving to religious organizations. They have to meet a lot of stringent tests, like they can't be discriminatory in certain ways, et cetera, et cetera. But would it be possible for the federal government to put money into religious charities in the same way? It might be slightly more controversial, right, if they're doing it through spending versus letting people put their money wherever they want, as long as these organizations aren't violating certain principles, and then just giving them a tax deduction for it, right? We sort of let consumer preferences be reflected in charitable giving in a way that we may not be able to do it in terms of spending. And there are other reasons, right? For example, one thing I study is the R&D tax credit, where we sort of let firms get a tax credit for their spending on research and development, because on some level we think that firms might have the best knowledge as to where to put the marginal research dollar when it comes to sort of innovating, right? We have another way of providing support for research in the US, which is the NSF and other sort of grant-making agencies, where they sort of look at different proposals and some sort of committee from the government, a highly qualified committee, but nonetheless a committee, sort of approves and decides where the money goes. There might be different reasons to favor each, right? It's likely true that where the marginal research dollar goes is different under these two programs. And we might value sort of the information that private corporations have about sort of where to put money. And that might be a reason we do tax expenditures in addition to direct spending. Matt, you had a question?
I was curious, did the subsidy for giving donations,
Yeah.
was that born out of the philanthropic culture of the United States, or was that something that helped create the philanthropic culture, or when did that?
I mean, that's a chicken or an egg thing that I don't really know. I don't know, because that would be a thing we only have time series evidence on, right? But sorry?
Is it common in other countries?
It's not as common as it is here. And one of the things you'll often see, so we'll talk about this in a minute, but tax expenditures for charitable giving are non-trivial. The tax expenditure is roughly $47 billion. So clearly more than $50 billion is given in charity each year, right? I was just making up a number there. But so the tax expenditure is very high. And sometimes there are ideas about reducing our tax expenditure on charitable giving by capping how much people can give to charity and deduct it from their taxes. Right? There are different proposals, and one of the major sort of interest groups that lobbies against that is sort of large philanthropic institutions, right? Because there was an era, right? A lot of the money made in the Gilded Age went to sort of create foundations that are actually dotted all around our fair city here, right? I once worked for the Mellon Foundation, and I think taxes might have motivated that in part, right? It's hard to know. We do know that, I can give you, again, anecdote is not evidence, but there are fun stories. The Howard Hughes Medical Institute began as a tax deduction. It wasn't for medical purposes. They wanted to save money on taxes. And then eventually they had to do something with the money, and they formed the Howard Hughes Medical Institute. So overall, I'm not sure, but there are people who do argue that our sort of very vibrant and big philanthropic sector in the US is partly due to our tax exclusion. So yes, I can't give you definitive evidence. Okay, so we talked about expenditures versus spending, right? Now let's talk about deductions versus credits. So we talked about how a tax credit gives you $1 of tax credit is a lot more money than $1 of tax deduction, right? In both in terms of return to you as the taxpayer and in terms of expenditures by the government, right? But which one we choose has some different impacts, right? So let's compare, suppose we had a tax credit versus a tax deduction for charitable giving. Right now we have a tax deduction. Whatever you give to charity, you can just deduct from your, as long as it's an eligible charity according to some rules, you can deduct from your taxable income, right? You can deduct from your, in your below the line deductions before you calculate taxable income. What we're saying is that we're going to, for every dollar you give to charity, we'll kick in tau cents of that dollar, right? Where tau is your marginal tax rate. So for a wealthy person, for a wealthy individual, for every dollar they decide to give to charity, the government's going to pay 35 of those cents, 35 cents of that dollar. So we're partially subsidizing all charitable giving. That's what we're doing, right? We're partially 35 cents on the dollar or whatever your marginal tax rate on the dollar for every dollar you give. There's another model, that's the tax credit model, where we could say, you know what, we're going to give you a full tax credit for every dollar you give to charity up to $2,000. That's a model in which we're fully subsidizing part of the charitable giving you do. Which one of these we want to do has a couple considerations, right? One is just simply how much response we're going to get. If we think that people, we often talk about elasticity as if it's one number. You could also theorize that elasticities are different at different parts of the spending distribution. People are very elastic at low levels of spending and get less elastic later, or the type of people who spend very little are inelastic, but people who spend a lot are very elastic and they would respond a lot to a bigger tax subsidy. We could imagine this pattern being one way or the other. That could help us decide whether we want a credit or a deduction, right? If we think people who give a lot to charity are the most responsive folks, we'd want to make sure our tax subsidy extends to even high levels of spending. We'd want to do the deduction. If we think that folks who are spending a lot on charity would spend a lot on charity anyway, but it's people who are barely spending anything on charity who would be responsive, we might want to favor the credit instead, right? Another consideration has to do with the distributional consequences. So with deductions, where does charitable spending come in deductions, above the line or below the line? Below the line, right? It's below the line. So if you choose not to itemize, you don't get to save money on it. You don't get to save income taxes on your charitable giving, right? So that says something about who's getting that benefit, right? It's people who are itemizing. So it's either people who itemize for other reasons, because they have a house, right, or they have other things, they have high state and local taxes, or they give so much to charity that it's worth it for them to itemize. Second, when it comes to credits versus deductions, right, credits have the opportunity for us to make it refundable and allow us to sort of provide this tax subsidy to people who are even not owing federal income taxes. So there's sort of two parts to sort of, when we talk about deductions versus credits, we could talk about this in terms of responsiveness as well as in terms of sort of distributional reasons. And within distribution, there's the idea of whether credit is above, whether the deduction is above or below the line, and second, whether we make the credit refundable. It'll change the sort of the equity implications of either of these choices. Any questions about that? Okay, so this you can look at on your own. This is just sort of an idea of, for different people, like for how people at different parts of the AGI distribution are saving taxes on employer-provided health insurance. Because as I said, we currently don't include that in your tax base, right? We never say, what is your employer spending on your health insurance? Let's add that in. And so we're providing a big subsidy to folks who get employer-provided health insurance. So you can read this on your own. Okay, so this is important, and it's going to preview next lecture. Okay, so here we have graphs of subsidies, right? If you'll notice, everything is identical for these two graphs, except the placement of P2 and the elasticity of demand. Elasticity is simply the steepness of the slope of demand. On the left, we have a case where demand is very inelastic. It's steeply sloped. On the right, we have a case where demand is more elastic. The size of the subsidy, here we're modeling the subsidy as a change in the supply curve. As we'll talk about next week, we could also do it as a change in the demand curve if you wanted, right? Kind of coming back from micro, right, faintly a little bit? Haunting you? Yes, yes. Okay, yeah, so here we're modeling it as a change of the supply curve. You'll see that the vertical distance between the supply curves is the same in these two diagrams, right? So the subsidy size is the same in these two graphs. All that's different is the steepness of demand. So in the case of very steeply sloped demand, i.e. inelastic demand, you'll see that a given subsidy leads to a bigger change in price, right? The subsidy changes the price paid by consumers from P1 to P2. P2 is much lower in this diagram than it is in this one. So in this case, imagine I said the statutory incidence is to the supplier. The government is sending suppliers some subsidy amount, let's say it's T, for every unit they produce. The statutory incidence is entirely on suppliers. But as you can see, it's how this market equilibrates, how supply and demand interact, that tells us who bears the economic incidence. Economic incidence, remember, is all about prices. In which case do consumers get more of the benefit of the subsidy? Say left or right? Left, right? Because the decrease in price is bigger in the left graph than in the right. And that's because demand is very inelastic. So a theme we'll hear a lot about when we talk about incidence, which will be a lot of the coming weeks, the more inelastic factor will bear the burden of the tax and gain the advantage of the subsidy. I often think of this as the elastic party runs away from the tax and kind of runs away from the subsidy too, which doesn't make any sense, but most of the time we'll talk about taxes, but it's sort of like the elastic party is not kind of bearing the tax or subsidy as much as the inelastic one. And the reason behind this is, remember when we talked about why demand is more or less inelastic? Did we talk about this already? Right? Maybe last week. When we think about the elasticity of demand, what we're saying is, how good are the substitutes this consumer has for this product? In the case of a product where other goods are thought to be very good substitutes, demand will be more elastic. And that's because if prices change very much in this market, right? So if you're a normal person, you find Coke and Pepsi to be very good substitutes for each other, right? When the price of Coke doubles, you're done drinking Coke, right? You'll just drink Pepsi if you find them to be very close substitutes. Your responsiveness to changes in price, in terms of changes to quantity, will be very high. A small change in price will trigger a big change in quantity because you're almost just as happy drinking Pepsi. In my case, right, I only like Coke. I don't like Pepsi at all, right? You might as well be giving me arsenic water. Will not drink it. I have really inelastic Coca-Cola demand. You can triple Coke prices. I don't have a substitute for it. There is no substitute out there for me. At some point, probably there is. But let's imagine there never is, right? It's a one-slope curve. It's a one-slope curve or a line. In that case, I'm not going to change my quantity very much for a given change in price. That's in terms of taxes, right? Let's think about subsidies. This is a subsidy graph. You always know it's a subsidy graph because the supply curve is being shifted down, right? The cost of the supplier is being subsidized. A trick is that in the case of taxes, our deadweight loss triangle will be on the left side of equilibrium. In the case of a subsidy, your deadweight loss triangle will be on the right side. And that's because in the case of a subsidy, units are being produced in which the marginal benefit to the consumer does not exceed the marginal cost of the supplier, right? There's overproduction relative to the competitive equilibrium. Okay, so let's go back to the inelastic case. So I forgot, I completely lost my train of thought. I'll just start talking and it'll come to me. Okay, so in the inelastic case, for a given change in price, quantity doesn't move very much. Which one of these cases has, so we said the consumer benefits more in the left-hand case, right? The price change is bigger. They get more of the economic benefit of the subsidy. In which case is the deadweight loss bigger? When it's elastic, because what is efficiency all about? Quantity. If the consumer is really responsive to price, right, they change their quantity a lot for a given price change, and we're going to get a lot of deadweight loss. Because there's a lot of excess transactions here, right? A subsidy in this market, in the elastic market, triggers a bunch more consumption because the demander is very elastic here. And all of those units create deadweight loss because the social marginal cost of producing that Coke is higher than the social benefit, the social marginal benefit, or the demand benefit of drinking that Coke. Okay, cool. Any other questions about this graph? So the elastic party bears more of, the inelastic party is going to bear more of the burden and get more of the benefit of the subsidy. More of the burden of a tax, more of the benefit of a subsidy. The relatively inelastic side of the market. Terrific. Okay, so this is a list of some large federal government tax expenditures. So as I said, the Joint Committee on Taxation puts out a compendium of tax expenditures every year, I think, and it's actually pretty interesting. So as you can see, the exclusion of employer contributions to health insurance, so the side of your health plan that your employer pays for, is one of our biggest tax expenditures. We spend, remember expenditures are spending, roughly $155 billion in terms of lost revenue on this tax exclusion. It's one of our largest health programs, right, is the subsidy of employer contributions to health insurance. The deductibility of home mortgage interest costs us another $108 billion in terms of lost revenue. Just to get a sense, the stimulus package was $787 billion, right? It was a huge deal. It's the biggest stimulus, it's the biggest spending bill ever in all time. And this is what we give out every year. So there's 401k plans. See, deductibility of charitable contributions is $47 billion a year, right? It's a lot. The capital gains exclusions from home sales. So when you sell your house, if you have capital gains less than $500,000 and you've lived there for a while, you don't have to pay capital gains on that asset appreciation. That's $31 billion. The deductibility of state and local income taxes is roughly $30 billion. So that's a non-trivial form of spending that we're doing, right? Subsidizing state and local taxes of some jurisdictions. The child credit, remember this is a credit for having a child? Not having one, like not producing one, but like being a parent, thank you. Having one reside in your home is $27 billion. The preferential treatment of capital gains income, so we tax advantage capital gains income, we'll talk more about that in just a second. That's roughly $29 billion. It's a billion here, a billion there, and soon enough you're talking about real money, right? In total, it's just $1.1 trillion of tax expenditures in 1 year. To give you a sense of that, it's roughly half of what we take in terms of tax receipts at the federal level. In terms of the deficit, it's almost the entire deficit. Eric.
What are economists saying about when I think 2014, when the health exchange is going to happen? What are they saying about their expenditures in terms of medical insurance? Are they going to go up or down?
It's hard to say. So there are theories that we could see a lot of dropping by employers, that they'll just pay the fee for not offering instead of actually offering, because these health exchanges could absorb their employees. But then you have to worry about the adverse selection in that market. We don't know. I mean, we'll find out when we find out. There's a lot of theories as to what could happen. CBO did not put a lot of that in there when they ran the model. They didn't look very carefully, because it's just too hard to predict. Because it's, we know a little bit about how things work with small changes in tax rates, et cetera, et cetera. This is a large-scale, huge reform. It's really hard to predict. And we'll talk more about that stuff when we get to healthcare and health insurance in the second half. Because I'll talk more about adverse selection and sort of how insurance markets work, what the connector is susceptible to, what it'll be good at, stuff like that. So yes, just get excited for the second half, of course. Okay, so I'm going to let you guys read about family versus individual income taxation on your own. Gruber's last section, I think it's 18.6, does a very good job of talking about it, and I trust that you can handle it. The bottom line is that you can't have a tax system that is progressive, horizontally equitable, and marriage neutral. This is a threesome of restrictions that are just, you can't do them. You can't do them all. It's impossible. And you can read that section as to understand the details of it. Okay, so this is again part of that. I'll have you read that on your own. So next week, the assignment is out of chapter 18, and there's one question out of 19. Recitation 2 problems are on Blackboard. If you didn't get to go to recitation today, they'll be up. Ignore the last bullet point of a discussion. Please do the readings for our next class before you get here. And the recitation 3 notes that are up will probably be tweaked because of our transition to having 2 recitations. So we'll adjust them so that it sort of works and makes sense. Okay, so let's go ahead and take a look at Mr. Romney's tax return. So this is his actual tax return from 2010. I have given you very few pages of his tax return. Does anyone not have one? Besides David?
Yes.
There you go. Anyone else need one? Did you get slides? Okay, so from now on, I mean, don't be shy. If you don't have slides, you don't have stuff, just tell me. Stopping lecture is not a big deal. Do you need one of these? Anyone? It's not a big deal at all. Please next time just stop me. It's, it takes 2 seconds, and that way you can follow along a lecture. So I would prefer you stop me and get slides. Okay. So I have given you very little of his tax return. I've given you the 2 pages of his, like the front part of his 1040, the summary stuff, and then I've given you his Schedule A, which delineates his itemized deductions, or there, because it's a joint return, and I've given you a Schedule D, which talks about his capital gains and losses. There is a lot more to this tax return, right? It's a vast and complicated tax return, like, a law firm put it together, right? So we're not going to go through all of it. I hope not. You can do it on your free time, but I imagine we all have better things to do. But we will talk about sort of why, I think it's been in the headlines a lot, or at least in popular discussion, whether or not the fact that his tax burden was roughly 13.9% of his income says something about our tax system that we care about, right? This has sort of been in the news a lot. So I wanted to go through this with you so that you can sort of understand why his tax bill was what it was. Okay, and then the last pages are my quick and dirty rundown of how to compute his taxes, right? It's quick and dirty because we're not going to get it right. We're going to be off by about $200,000. So I don't know what the differences are. I've not looked to see what, I'm sure there's stuff in the rest of the return that will explain it. We're off by a little bit. But okay, let's go ahead and get started. The first page. Okay, so we can ignore the top stuff. He lives in Belmont, Massachusetts, et cetera, et cetera. So line 7 is wages, salaries, tips. This is like labor income. He actually didn't have any in 2010. Next line is taxable interest. So he has $557 of tax-exempt interest. That's like interest on municipal bonds or local bonds or state bonds. That's tax-free. You can see that he has roughly $4.9 million of interest income. So in this country, you pay taxes on interest income at the ordinary income rate. And the ordinary income rate is the sort of schedule we looked at earlier, right? There's another tax system for capital gains and dividends, which are tax favored. If you're in the bottom 2 tax brackets, you pay 10 or 15% as your marginal rate. You pay 10% on capital gains and qualifying dividends. If you had a marginal tax rate above 15%, you pay 15% on your capital gains and qualifying dividends. The vast majority of people are in the 15% capital gains bracket, right? So why is this? Why is interest income taxed as ordinary income while gains and dividends are taxed differently? It's because corporations get to deduct interest payments from their income when calculating profits. So corporations aren't taxed on interest payments they make. They get to deduct interest payments like they get to deduct the cost of materials or the cost of wages to their workers, right? So they haven't paid corporate taxes on interest they send out to bondholders. So we tax individuals at the full ordinary income rate on that type of income. Dividends, on the other hand, are sort of out of profits, right? They're paid to shareholders out of profits. A corporation has already paid taxes on profits by the time you get them. There are some circumstances where a corporation has not paid corporate taxes on those profits. Those dividends don't qualify for the lower 15% tax rate. So when we get to his dividend income, which is below, right, which is he has roughly $3.3 million in qualifying dividends. On the other side, there's $4.9 million. That's total dividends. That's ordinary plus qualifying together. So you can see he has roughly $1.6 million in non-qualifying dividends. So there are some entities aren't paying corporate taxes. So when they send out their dividends, you have to pay the ordinary income rate on those, rather than the tax advantage 15% rate. That makes sense to everyone? That distinction between interest and dividends and different types of dividends. Okay, terrific. Let's see, what else does he have? He has roughly $826,000 in refunds. That's sort of refunds from other levels of governments, maybe the federal government. It's sort of refunded. It's state and local tax refunds. Sorry, it's state and local tax refunds. He has $826,000 worth of that. He has business income of roughly $594,000. He has capital gains, total capital gains of roughly $12.6 million. So go ahead and turn to Schedule D, the 4th page of your handout. So capital gains have to be divided up into 2 kinds of capital gains. One is short-term gains and one is long-term gains. When I said we tax capital gains at only 10 or 15%, that's long-term gains. Short-term capital gains, so let's say you buy and sell a stock within 1 year. You make some money on GM and you sell it, you cash out. That's a short-term gain. That capital gain is taxed as ordinary income, the kind of rates we talked about up here. It's only your long-term capital gains that are tax advantaged and taxed at 15%. So on Schedule D, he divides them up. In line 7, you can see he had $455,000 of short-term gains, while he and his wife had $12.1 million of long-term gains. So when we look at his total, part of that's short term, part of that's long term. Line 14 tells us his other gains or losses, and that's roughly $1,500. He lost money in either real estate, for rental real estate, royalties, partnerships, S-corps, and that's roughly $280,000 of losses, right? That's line 17. He lost another $273,000 in other types of income. And then if we look below, right, these are the adjustments to AGI, right? These are the above the line deductions. He is self-employed because he has partnerships and stuff like that. He's a self-employed, so he has to pay both sides of his FICA to the government, right? What we see in our paychecks is just our side. Our employer has remitted an equal amount to the government, but he has to pay both sides because he's self-employed. There's no firm, right? It's him. So he gets to deduct half of his self-employment payroll taxes because employers get to, right? They get to deduct that from costs and not pay corporate taxes on it. So he gets to do the same. So he gets to deduct $14,576 from his gross income. And he actually gets this thing that I'm not going to get into called the domestic production activities deduction. Like it's activities. It's like a subsidy for sort of certain activities here in the U.S. He gets $261 of that. So I'm not going to get into it. It's a small thing. Just go with me on that one. So when we take his gross income of $21,661,344 and deduct his adjustments of $14,837, we get $21,646,507. So let's go to the spreadsheet I put together. I want to tell you how we're going to now run that through the tax system, right? So his wage bill, which will be taxes, so there's the rates, either say ordinary or 15%. Ordinary is the type of rates we talked about here, the federal income tax schedule. To 15% is his advantage rate. So wage income is 0, that would be taxed as ordinary income. His taxable interest, his $3.3 million of taxable interest, is ordinary income. His short-term gains, the $455,000, that is short-term, is taxed as ordinary income. His remaining $12.1 million is tax advantaged at 15%. His dividend income, roughly $1.6 million, is non-qualifying. So the vast majority of let's say the vast majority of taxpayers who invest in publicly traded firms, virtually all the dividends you receive from publicly traded firms are qualifying dividends. But he has some special sort of income streams that come from non-qualifying, income stream sort of sources that are non-qualifying. So he actually has a substantial amount of non-qualifying dividends, which is $1.6 million. That part of it's taxed as ordinary dividends, and he pays the advantage rate on $3.3 million of his dividends. His taxable refunds and his business income are both taxed as ordinary income. This is business income from like partnerships, et cetera, where the income isn't retained in the corporation, it's not incorporated, it just goes to the individuals or partners every year of that firm. His other gains are in there at ordinary rates. He can deduct his rental losses and his other income losses from his income, his positive income, and that's ordinary as well. So we have his above the line deductions, which again are his self-employment tax and his domestic production activities exclusion. So let's now go to his deductions, which is the second page. You know what? You guys can follow this on here later. Let's actually go to the worksheet. So I've pulled this out. Some of the details on the second page, some of it I've pulled out from elsewhere in the return. So he paid $672,000 in state and local taxes. Actually, if we go to Schedule A, sorry, I'm poorly navigating his return. The third page I gave you says itemized deductions, right? So he paid in state and local taxes, which is line 5, $672,000 and $672,000 in local taxes. He has other real estate taxes of $226,000, right? And let's see, his real estate taxes is state and local, and his other itemized deductions are $3.6 million. The bulk of that is the $3 million in line 19 of Schedule A that are charitable gifts. Right, charitable gifts in there. He has a lot of job expenses as well, but he has a lot of charitable gifts. That's the bulk of his other itemized deductions. He gets to take personal exemptions, right? His personal exemptions amount to $7,300. The truth is his are actually phased out eventually, and I'll show you where that is later on. So we get a taxable income of $17.1 million for Mitt Romney and his wife. A portion of that, roughly $1.7 million, is taxed at an ordinary rate, and the remaining sort of $15.5 million, or $15.4 million, is taxed at 15%. I got a regular tax bill for him and his wife of roughly $3 million. The main driver of this low tax bill is what? The vast majority of his income comes in dividend income, and it's tax advantaged. right? That's where a lot of his low tax rate comes from. That a lot of his income is taxed at a 15% rate because it's, I'm sorry, not as dividend income, it comes as long-term capital gains. A lot of his income falls into there. Roughly 12 million of his $21 million of income falls in there. And then he gives a lot to charity, right? And that offsets his ordinary tax base. And that's sort of one of the main reasons. Those are the two main reasons why he paid such a low rate. If we go back to his return, the second page, if you look at line 44, it says that his taxes owed is 8.8 million, roughly 8.9 million. No, sorry, 2.9 million. I can't read. 2.9 million. That's where I'm off, right? I got 3 million, and somehow they came up with 2.87 million. So I'm off. I'm off a little. He does owe the AMT because, like I said, the AMT. Did we talk about the AMT? We haven't talked about the AMT. The AMT is this alternative tax system that's in place to make sure those that have a lot of exclusions and deductions relative to their taxable income, it prevents them from escaping income taxation at the federal level. You can read the story in your chapter about where it came from, but the whole point is that everyone has to pay something. So what happens with the AMT is the following. You basically have to add back in, to a large degree, all their exclusions and deductions. You get to take a personal exemption of $46,000, roughly $47,000. That's your personal exemption under the AMT. And you have to pay taxes at a 26% rate at everything above that personal exemption up to $175,000. And you pay tax at 28% over that amount on everything else after $175,000. Every man, woman, and children with income in this country owes the higher between their regular tax burden and their alternative minimum tax burden. For most of us, our deductions and exclusions are not a large enough share of our taxable income for the AMT to be our higher tax bill. Right? Our regular tax actually ends up being our higher tax bill. So we pay the regular tax. For some families, their exclusions and deductions are so large that the AMT then kicks in. The AMT was meant to affect only the very wealthy. Increasingly, because first of all, the AMT brackets were not indexed for inflation, and there has been inflation is one reason. The second reason is, imagine there's two tax systems, the AMT tax system, and then there's the regular tax system. You have to pay the higher of the two for you. Some people it's like this, some people it's like this, and they pay the higher there too, right? But in 01 and 03, we cut taxes in the US, but we only cut regular taxes. If we cut the taxes owed by one system, and you pay the higher of the two tax systems, it's going to mean more and more families shift onto the AMT, because that burden becomes higher relative to the regular tax burden. So to prevent middle-class families from sort of landing onto the AMT, we keep passing these one-year patches that sort of fix up the AMT such that most people don't have to pay it. Mr. Romney and his wife, on the other hand, did have to pay it. They actually owed an additional $233,000 under the AMT. And so their total tax bill came out to $3.1 million. I couldn't get that exact number with my sort of quick look at his return. I'm sure we can reconcile it if we spend enough time on it, but it wasn't my interest. But there's two reasons we went through this return is so that you got something more interesting than Jack's $60,000 of wage income to look at. You kind of got to see what a 1040 looks like in real life. I'm sure many of you fill out your own, you see what it looks like. And I also wanted you guys, as someone who's taking a class that's talking about taxes now, you should be more informed than the average person walking around New York, even in your income, and even in your education class. You should be more informed than them about what's going on with tax policy in the news now. So that was the whole point. It won't be on the exam. No one's going to ask you why. There could be a question, true and false, about the general ideas behind this, right? Like Mitt Romney, his wife, paid a lower tax rate lower than 15%, because his business losses were excessive. Is that why? False, right? It wasn't his business loss. It's the form of income he gets. It's the form of income he gets. Okay, terrific.